Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in plain sight within corporate filings. Get ready because Everest Group Ltd's latest report is packed with some serious financial acrobatics and a few unexpected twists that could change how we see the insurance and reinsurance world. This 10Q filing from Everest Group Ltd gives us a peek into their financial performance for the quarter ending the 30th of September 2025. And let me tell you, some of the numbers are eye-opening, especially when you compare them to last year. They are a big player in reinsurance and insurance, and this report tells us if they are still riding high or if the market is starting to bite back. Let us dive straight into the numbers, starting with their balance sheet. Total assets have grown to a whopping $62.2 billion, up from $56.3 billion at the end of last year. That is a healthy jump, showing they are expanding their business. Now think about what that means for you as a consumer or investor. It means the company is likely taking on more business and investments. Their investments and cash combined stand at $45.8 billion, a significant increase from $41.5 billion. This is crucial because insurance companies manage vast sums of money, and how they invest it directly impacts their stability and profitability. They are putting more money to work, which is generally a good sign. But here is where it gets interesting. Their reserve for losses and loss adjustment expenses has also climbed substantially to $33.7 billion, up from $29.9 billion. This is the money they set aside to pay out claims. An increase here could mean a few things. It could mean they are writing more business with higher potential payouts, or it could signal concerns about rising claim costs. It is a critical number to watch. Now let us look at how they performed in terms of income. For the 3 months ending the 30th of September 2025, their net income was $255 million, down from $509 million in the same period last year. That is nearly a 50% drop, and that is significant. Over the 9-month period, their net income also fell from $1.9 billion last year to $1.1 billion this year. Roughly a 40% decrease. On the revenue side, premiums earned for the 9 months increased to $11.7 billion from $11.3 billion last year. So they are earning more money from their core business. However, their incurred losses and loss adjustment expenses for the 9 months shot up by 15% to $8.2 billion from $7.1 billion. This widening gap between earned premiums and incurred losses is a key reason why their net income has tumbled. This is directly reflected in their underwriting results. For the insurance segment, the underwriting gain has turned into a significant loss of $357 million for the quarter, compared to a gain of $28 million last year. This is a major swing and points to challenges in their insurance operations. The reinsurance segment also saw its underwriting gain shrink considerably. The combined ratio, which measures how much an insurer pays out in claims and expenses for every dollar of premium earned, has worsened. For the 3 months, it hit 103.4%, up from 93.1%. This means they are paying out more than they are earning in premiums from their underwriting activities. For the 9-month period, it rose to 98.7% from 90.8%. A combined ratio over 100% is generally not good. Where are they making up some of this ground? Their net investment income has increased to $1.56 billion from $1.48 billion for the 9-month period. This indicates their investments are performing reasonably well, helping to offset some of the underwriting losses. However, their net gains or losses on investments have moved in the wrong direction, going from a gain of $50 million last year in the 9-month period to a loss of $59 million this year. So while their investment income is up, their capital gains are down. Looking at their financial health beyond the income statement, let us check their credit facilities. They have several active committed letter of credit facilities totaling up to $1.6 billion. These are essentially lines of credit they can draw on if needed. They also have Euro and British pound sterling facilities and some uncommitted ones for added flexibility. This suggests they have access to funds, but it is important to remember that this is debt. When we look at their investments, particularly fixed maturity securities, there is an allowance for credit losses. For their available for sale securities, this allowance stood at $51 million at September 2025 compared to $36 million at December 2024. This means they are anticipating some of these investments may not pay out fully. They are also holding on to securities that have lost value as of the 30th of September 2025. Their fixed maturity securities available for sale had unrealized losses totaling $708 million. A significant portion of this almost $700 million relates to securities that have been in an unrealized loss position for less than 12 months. This could be a temporary market dip, but it is something to monitor. Now let us talk about a really interesting recent development. On the 26th of October 2025, the company entered into adverse development cover reinsurance agreements. This basically means they are transferring some of their old and potentially under-reserved liabilities to another company. Think of it as an insurance policy on their existing insurance policies. They are transferring $1.3 billion of reserves in the first layer and paying $122 million for the second layer. This is a move to reduce future uncertainty and protect their finances. In a major strategic move on the same day, the 26th of October 2025, they agreed to sell renewal rights for certain commercial insurance businesses to American International Group, Incorporated or AG for $252 million plus additional payments for expenses. This signals a potential shift in their business strategy, perhaps focusing on core strength or exiting lines of business they deem less profitable or too risky. Let us circle back to the financial health. That unfavorable combined ratio of 103.4% for the quarter is concerning. The loss ratio, a key component of the combined ratio, increased by a hefty 7.6 percentage points to 73.6%. This means a larger chunk of their premium dollar is going towards paying claims. For the 9-month period, it also increased by 6.8 percentage points to 70.1%. This indicates a worsening trend in claim payouts relative to premiums. Despite the reduced net income their shareholders, equity has actually increased to $15.4 billion from $13.9 billion. This is thanks to strong investment performance and positive translation adjustments from foreign currency, which helped bolster their equity base even as profits declined. When we look at the risks they face, it is a familiar list for companies in this sector. Catastrophic events, insufficient reserves, and market volatility all feature prominently. They are particularly worried about losses from catastrophe exposure exceeding their projections. In their investment portfolio, they hold a significant portion in US Treasury securities and obligations of US government agencies and corporations valued at $752 million as of the 30th of September 2025. This is a typically safe investment, but even here they show some unrealized depreciation. It is also worth noting their Federal Home Loan Bank membership, which allows them to borrow substantial amounts. As of the 30th of September 2025, they had $1 billion in borrowings outstanding with capacity for much more. While this provides liquidity, it also represents debt that needs to be managed. So putting it all together, Everest Group has had a challenging quarter and year to date in terms of profitability, with net income dropping significantly. This is largely due to higher claim costs and unfavorable development on prior year reserves in their insurance and reinsurance businesses. They are trying to mitigate some of these risks by entering into specific reinsurance agreements and divesting certain business lines. That jump in the combined ratio to over 100% is a big red flag. It suggests they are not underwriting profitably right now. However, their investment portfolio is a strong asset and continues to generate income, helping to cushion the blow. The increase in shareholders' equity is also a positive sign indicating resilience. Looking ahead, the company appears to be actively managing its risk profile through strategic sales and reinsurance deals. The key question is whether these moves will be enough to turn around the profitability of their core insurance and reinsurance operations in the face of rising claims and a competitive market. The sale of retail commercial insurance renewal rights suggests a sharpening of focus, perhaps towards more specialized or profitable areas. The biggest risks remain the unpredictable nature of catastrophic events and the trend of increasing claim costs known as social inflation. On the flip side, if they can successfully integrate their growth in specialty lines and continue to benefit from strong investment performance, they could emerge from this period stronger. Their move to divest certain retail operations might allow them to concentrate on their more profitable reinsurance business. In conclusion, Everest Group is navigating a tough market, showing both strength in its investment capabilities and equity growth, but also facing significant headwinds in its underwriting operations. The management appears to be taking proactive steps to address these challenges, but the next few quarters will be critical to see if these strategies will lead to a return to robust profitability. Alright, that is our breakdown of Everest Group's latest financial report. What do you think about these numbers and what they signal for the future of this insurance giant? Let us know your thoughts in the comments. If you found this analysis valuable, do us a favor and hit that like button. It really helps us out, and be sure to subscribe for more deep dives into the world of corporate finance. And if you want to connect with like-minded individuals and discuss these reports, further join our Discord community linked in the description below. Thanks for watching. See you next time.